Rick, we're back, man.
It's been a while.
It has been a while. We've been very busy in the business, everybody. So we thank you for listening in to us today. This is our podcast number 4. And we're going to do this one a little bit different, somewhat the same concept, but I think we need to kind of tell us everybody about, what makes us a little bit different. Rick, why don't you tell us from your perspective, what makes L&Y different from, I would say, other business and tax advising firms that are out there?
Sure. Yeah. One of the things that you and I talked about when we got back together was that, we wanted to create a firm that was not just another tax firm.
Yeah.
We just didn't want, we wanted to separate ourselves from kind of what most people think of from just a basic tax accountant. My background's always been business advisory. I know yours has been too.
Yep.
My background's oil and gas and real estate.
Mm-hmm.
And those industries by and large need a lot of help. They need a lot of advisory work and a lot of business structuring. And that's kind of the way we built this business. Was we wanted to create something that would come in and people would see us as more as a trusted advisor, not just their compliance officer that filed their tax return.
The boring work.
Right.
Yeah.
Right. And that's what, I think most people, when they think about the tax person, that's just the person I see once a year to hand my documents off and get my necessary stuff done.
A necessary evil.
Right.
Basically. Yep.
And we didn't want to be that.
No.
Right.
No.
And so we wanted to be more of that person that you went to that was like, I heard that this might work for me, but what do you think?
Yeah.
Right.
Yeah.
And so that's the way we structured this firm as we want to see you a couple of times a year. We want to talk to you about how your business is going. If we can help you find that tax deduction, we want to help you find that tax deduction.
Yeah.
But at the end of the year, we wanted you to be able to know that your taxes were already pretty much done. Right.
Right.
That all it was a matter of just getting the filing done. That there was no, I don't know where my taxes are going to be at. I don't know if I'm going to owe. I don't know. You should know at the end of the year, if you're working with us really well, if you're going to owe anything, which hopefully we won't. Hopefully we've helped you make those estimated payments throughout the year.
Correct.
If there's there should be no big surprises, right? No, that's the whole point.
Yep.
No business owner likes getting a big surprise that they can't plan for or pay for.
Absolutely.
And that's really the way we built this business.
Yeah, absolutely. I would agree. I would say, Rick, to even double down on that some more. And, you hear in all of our meetings that we talk about all the time, the people matter. Right. Yeah. It's the relationships. Right. I always say it's people over profits.
Yeah.
Because behind every business, behind every entity that is out there, it's individuals that are working those businesses.
Yeah.
Right. Everybody, I think the common knowledge is, they like to separate business from people. Right. But you really shouldn't at the end of the day, because, you can start up a company and you can go, raise some capital or have a capital injection. And then, you say you have $100,000 sitting in a bank account. Well, at the end of the day, that's just a large bank account, right? What are you going to do with that, right? What services are you going to sell? What products are you going to sell? It takes organization. It takes having the right team. And quite frankly, whoever your trusted advisor is, I always try to predicate it on, I was asked one time, what makes you different than somebody else? And I would always just say, I just care more than the next guy. Right. That's what it is. It's care. Compliance is compliance. And theoretically, everybody in this industry, if you say you're a CPA, an EA, whatever, you should be able to do the compliance work. You should be able to. Not everybody can, but you should be able to. What sets you apart and sets you different is, the relationships that you have with your clients. And I always say, I want to dive deep, right? Not that I necessarily want to be in that person's industry and actually do that business, but I want to learn all the nuances of their business. And then from that perspective, once we break it down, understand what the drivers are in that business, then I can offer the advice necessary, right? To either take them from zero to, a few million a year in revenue, or from a few million years to we've taken them to deca millions, to some of our largest clients a day do what, $250 million a year in revenue?
Yeah.
Right. And it's that iterative process that, you see that growth, and it's all, like I always like to say, it's almost like a baby. You know, if you don't give that baby the nourishment and the nurturing that it needs, that baby will die. Well, guess what? So will that business.
Sure.
You know, and so whoever you select to be your trusted advisor, from a tax compliance perspective, from a CFO perspective, whatever it is, they better be an extension of you. They better be all in like you are. And if they're not, you know, you need to find somebody else.
Yeah, absolutely.
You know, some of the things you hit on, Rick, and I'll let you talk about it, is, you know, calculating the estimated payments, you know?
Yeah, and that's what I think a lot of people miss out on every year is, you know, your taxes are actually due throughout the year. They're not due at the end of the year. And so what we want to help people understand is how do you calculate that estimated payment and making that estimated payment, and what that's going to help you avoid from penalties and interest of the IRS. If you wait till the end of the year and make one lump sum payment, the IRS will still charge you a late payment fee because they expect that money to have been paid throughout the year. And we can walk you through how that works and how you do the calculations on stuff. But we like to do that with you. That's the reason why we like to meet with you a couple times a year, right? So Absolutely. If we're having phone calls or you're a sit down meeting with you, we want you to understand kind of where your business is at, what we project it's going to do for the year, and then what we think your overall tax burden is going to be, so that you can already go ahead and plan that from a financial standpoint, right? Because that's the other issue most people come into is cash flow.
Yeah.
How do I manage the cash flow, and how do I make these payments so I don't get in trouble with the IRS and end up with all these different things? You know, and you and I have been talking about here lately, what we want to do is we want to get away from the nickel and diamond.
Yeah.
Right.
Yep.
We don't want our clients to feel like they can't come meet with us because they're going to get another bill.
You know, and I think back to, and I know, you know, you and I started around the same time, and we worked at some of the same firms and know the same people from back in the day. And that's what we kind of aligned with everything is, it was all about billable time back then, right? And, you know, Rick and I, we have a different mindset, more of an outside the box thinking, right? You shouldn't be penalized every time you have a question. Now, we understand, like, you want to capture your time as much as possible, but, you know, when it gets to the point where the client never wants to call you because they're in fear that, well, heck, if I call them, I'm going to get hit with a 15-minute bill, or, you know, for 15 minutes of their time, whether it be email or whatever. And they go, well, I don't really know if it's worth it.
Right. Because what if you don't get the answer you want to hear, right?
Or even if you do, maybe the value's still not more than the cost, right? And so it creates this negativity, this disdain between your CPA, your EA, your tax professional, and you as the business owner or as the individual.
Yeah.
And so
so we kind of moved away from that. And what we're doing is more of a value-added proposition where we come in and we say, we think our services are just worth this, and this is all you're going to pay to have access to our firm, to our people, to Jake and I, so that we can help you grow your business the way it needs to be, so that you're not worried about, again, getting that extra bill. And so we've structured our fees around the idea of it's just a value. You know, a tax return's a value, an advisory service is a value, an IRS compliance letter is a value, and it's just, it doesn't matter how long it takes us to do it. It's just, that's the price. And that's a peace of mind for a lot of people.
Absolutely.
To know that it's just going to cost me this, it's not going to cost me more.
Well, and you mentioned earlier about cash flow, right? And that's part of cash flow. You can budget what your expenses are. Right. So when we offer those budgeted flat fee rates, they know month in and month out what it's going to cost. Right. So it's not any surprises that, wow, I just got a bill for $1,500. I didn't expect this. Right. So they know what they're going to get. And then, Rick, when we talk about our CFO services, right? One of the things that's really great is we like to set our metrics in there where we guarantee you're going to reach certain metrics. Now, look, you got to still do the work. Okay. We're going to advise you. We're going to tell you what you need to do to get to that next level, right? Where you're going to set up your goals, what you're trying to accomplish. And we're going to set the metrics on there of which numbers you're going to hit. Okay. And we're so confident in the work that we do when it comes to CFO services that you're going to hit that we offer 110% money back guarantee on that. Now, not many people will do that, right? But we're that confident. And so we're very selective when we bring those clients on board, because we only want to deal with people who are committed to success, right? And if they're not committed to success, if they're like, well, I just want to hire you to be my CFO and you're going to do all the work, Well, then that's not going to work, right? So we're the coach per se in this. We're going to give you the resources, the tools, and what you need to be doing, give you the proper advice. We're going to meet with you, right? Depending on what package you sign up for, we're going to meet with you whenever you want to meet that aligns with your package to get you to that next level. And we're going to guarantee that we're going to hit certain metrics, assuming you do what you're supposed to be doing. But the key is, like I say, and you know this, we're very selective on who we bring on for those CFO services because we also want to be rewarded in the sense of we want to see you successful. It warms my heart when I see another business owner successful. I know it does yours as well.
Yeah, when you first talked to me about adding this kind of a service, it's one of the things I'd always wanted to do. But I'll be honest with you, it was always a struggle for me. But how do I do this? How do I figure out how to be that CFO advisory person for a business owner? And I know this is kind of one of the things that you really love, right?
Yeah.
So tell the audience how you kind of decided that this is the way we wanted to go with it. And then the things that you're doing with some of our current clients that they're seeing the benefits from doing this.
Yeah. So it's multifaceted what your question is there, and we'll hit on that. So a little bit about my background. I have a doctorate in business finance, right? And so not a lot of, I would say, accountants or financial advisors or CFO people actually do have that credentialing. So I actually went to school for this because I believe in this. I believe in transforming organizations, transforming people, helping them get to that next level. But I always try to put myself in the driver's seat, right? In their seat. Like, what is going to, because look, let's be honest, CFO services is expensive. It's not cheap.
Right.
What are going to be their pitfalls or them not wanting to do this, right? Well, obviously the cost, right? Do I actually achieve the results that I say I'm going to achieve? So for me, I need people that are all in, right? So our client base that comes on board and they decide they want to do CFO services for you and I, we need those individuals who are committed to success. So if it's someone that they're lukewarm or they're just on the fence, right? I know at the end of the day, they're not going to be a good candidate. It's not going to be a good fit, right? So, we are very selective, just like they should be selective on who they choose to be their CFO. And we dive deep, right? So we're gonna get into your financials, but the financial aspect is just one element that's associated with that. Yes, we're going to look at things and we're going to break it down and we're going to discover what the drivers are behind those numbers. But I tell you, one of the biggest keys to success on this, Rick, is accountability. If you don't hold that person accountable, how are they going to actually do it? They're not, right? So you asked what one of the stories was. So it was ironic. This was not too long ago. One of our clients came to us and they said, look, we're looking at retiring. Husband and wife own the business, right? And they said, we want to sell the business. And when we reviewed everything and their EBITDA numbers didn't necessitate what they thought their valuation was worth. We had to do a lot of cleanup and we're still doing some cleanup on it. But I tell you what, we've been working with them now for, probably close to 9 months now. Okay. And their whole perspective has completely changed, Rick. They went from, they were ready to sell their business, like tomorrow if they could, to now they're so reinvigorated in the business and we are doing, just amazing changes in their business that they want to go potentially another 5 years before they want to sell. That to me, that's what gets my juices going, right? That's what gets me pumped up and go, okay, when I can change someone who is ready to retire and just everything they've worked for walk away to now they want to do this for another 5 years. They're okay with it. That's exciting to me.
Yeah. No,
that's absolutely exciting.
That's a great point, right? So, the problem I think with a lot of business owners ends up being the burnout, right?
Yeah.
And how do you get them, to stay committed to the business? And that's one of the things that you've tried to do with the CFO services is help people kind of get fired back up about their business.
Absolutely. Yeah. I'm a big sports fan.
Oh, yeah.
Right? You know that.
Yeah.
Right? And any sports athlete, I don't care if it's football, baseball, basketball, whatever it is, they all have coaches, right? But you got to be very careful in the financial sector when you start talking about business coaches, because I know you and I looked at it and they have a lot of non-credentialed people that are out there that classify themselves as business coaches. So, it's a very loose term, and I don't like to even put myself in those categories, but essentially that's what we are. We're business coaches that also handle the CFO side of things. We hold them accountable, right? We have, monthly meetings with them. We're constantly involved. Our staff is constantly involved with them, oftentimes on a daily basis. You know that. Maybe not every day. Sometimes it's, 2 or 3 days, 4 days a week, but sometimes it's 2 or 3, 4 days in a row, going back and forth, helping clean up their financials, recategorize things, looking at something, should it be on a cash basis or accrual, because, you've got some receivables here, and from the matching principles on the cost of goods, is it a true and accurate depiction of what actually is going on with that organization? Or do you have some receivables, and once you flush those receivables back through the business, right? Is that more of an indication of the EBITDA, what the profitability is of the company, right? So most people think when they talk about business, well, you should just be working on increasing your margin. Well, margin is just one thing, okay? The other thing that I always like to say is business growth happens even greater when you talk about increasing the velocity at which money turns over. So the quicker you can, have different revenue streams coming in, there's a diversification that's associated with that. The faster you can have the velocity at which revenue turns over into the business and hits your bank account, the quicker the growth is. So maybe if you have to take a little bit less margin, but you have greater velocity at which is turning over, greater growth, greater profitability you'll ultimately have at the end of the day. So there's all these different variables we look at when doing CFO work. That's why we set specific metrics in there to say we're going to hit these metrics. And I mean, completely indicative of this last client that I just mentioned. It went from a push and pull on the front end, right? It's like almost like somebody who's obese, right? And they're trying to get into the gym and start to get their diet and everything where it needs to be, to, man, they're amped up. They're ready for our monthly meetings every month, Rick. They can't wait to discuss what we've just done for them and what's coming next. And that is so, so encouraging. That is so encouraging.
That's awesome.
One of the things and that we bring on new clients that come on board is IRS audit protection.
Yeah, we're doing that now. It's for a small fee that's just added to your tax return fee. That for 3 years, we're going to guarantee that we will cover any audit, any IRS compliance letter, anything like that. If we file that return, you're protected.
That's right. That's right. And guys, that's not just for federal, that's state as well.
Yeah.
So you're federal and state, you are protected. Rick, we talked about it a little bit. I want to kind of hit on it just a little bit more, but entrepreneurship, man, it's a lonely road oftentimes for a lot of people, right? Like, let's just, maybe a husband or maybe a wife might be the business owner in the relationship. And sure, you might have a supportive spouse there, but do they really know what you go through? It's tough, right? Like, unless you're invested in it, you really don't. And a lot of your peers that you associate with, they don't know either, right? Can you elaborate on some of the pitfalls that most business owners face? You want to start at the beginning, the entity formations and everything that's associated with that, because that's part of business structuring and tax structuring, is making sure they have the right entity set up, right? And not having someone to come back to and talk to. It's a lonely road for those individuals that are out there.
It is. And I'll just kind of give my own backstory, because I think almost anybody that wants to get into owning and running their own business can kind of understand where this comes from. So most entrepreneurs, where do they start? They start, they're an employee for somebody, right? And they develop some really good skills. Maybe it's some sales skills. Maybe it's just really like a niche market, and they know the ins and outs of that market. And they decide, you know what? I can make a go of this. I can make a business out of this because I'm really good at this. And so they start their own business. And this is what I did, right? The problem is your head is in I'm really good at my craft.
Yes.
I'm really good at my craft, but I don't know anything about running a business.
Exactly.
Right? And so you start your business up and you don't understand what the startup costs are going to be. What all do you need? What is an LLC and why do you need one, and which one's the right one to pick?
Yeah.
And do I need an attorney, right? Do I need an accountant? Do I need someone that can market for me, or am I going to do it all? What do most entrepreneurs do? They are I wear every hat under the sun.
Everything.
I'm gonna save the cost. I'm gonna do it myself.
Bootstrap the business.
Yeah. Well, if you're doing all of that, who's running your business, right? And you are. And so you're burning the candle at both ends, literally, right? You're working 24/7 trying to get this business up off the ground and trying to save the money. I think most entrepreneurs don't realize how expensive it is to really to run a business, and they call that a barrier to entry. And some people think, well, there's nothing to it, right? No, there's a lot more to it. Maybe there's software that you have to buy. Maybe there's an accounting system, QuickBooks, that you have to buy. Depending on the industry, there may be some subscriptions and or licenses that you have to buy to get into. And those all have some financial costs. Developing a banking relationship, right? Yep. Everybody needs a banking relationship with their banker, because you don't know when you're going to need to go in and have a line of credit set up or some way to get a little bit of capital, because maybe there's a huge project you have the potential to get, but it's going to take some upfront capital to get into that project.
Yep.
And that's, I think the education piece is the biggest piece of it that most entrepreneurs are unaware of.
Education is huge, Rick. And this is one of the, and you've heard me say this before, theory's not always reality in business. Oh. Sometimes it is, but not always, right? Theory is theory, okay? And so what you think will work doesn't always work. I'll tell you a funny story. When I started my practice 16 years ago, I did a little research on my own, and I thought the way I was going to generate leads and new clients to come on board was through direct mail. So I created all these little postcards, or I hired a company to create all these postcards. And the first time I did, the first year, Rick, I hired them. They created all of them. I paid for their bulk postage. They actually shipped them from Florida, okay? And I did it within like a 10, 15-mile radius of my office at the time. Man, I tell you what, I spent back then probably $7,000, $8,000. Okay. I think I maybe got 3 clients, like horrible results. Right. But all the research said you're going to get 1% to 2%. It was just not true. Right. It depends on the industry. It was a very broad term.
It is.
And then the next year I thought to myself, I said, well, they mailed this out, these postcards. Maybe they didn't mail all of these out that I paid them to do. So the next year, what I did is I had them produce them again, mail them to me. I bought my own bulk mailer at the U.S. Postal Service. I physically mailed them out myself, hoping I would get better results. I got a few more, but it was still horrible. It was, so I was in it about 16 grand in between the 2 years. I think maybe I got $3,000 worth of work out of 16,000. That wasn't 3,000 profit. That was 3,000 in revenue. Okay. Horrible. It did not work for me. It didn't work for the industry. Maybe I did some things wrong. I don't know. But there again, that was theory, was not reality. I just read it. I Googled it. I read up that 1% of bulk, 1% to 2% of bulk mailers out there was going to, you were going to get that. And I did the math. Said, oh, well, this should pay for itself. It didn't, Rick.
Yeah, we made the same mistake on a different business that I own, doing the same thing. Right, we bought into the bulk mail, sent out a couple thousand pieces of mail to it, thinking 1% to 2%. That's all we need. Mm-hmm. And what we found, same thing with you, was the return rate's actually around 0.05 to 0.1%. Yeah, 0.05 to 0.1%. Right.
Yep.
So you need actually to do 10 times the number to get what you want to get out of it. And for most people, that's not cost effective. You just can't. I mean, can you think about spending $70,000 or $80,000 on a bulk mail every year to get maybe 10 or 15 clients versus 2 or 3?
No.
And that's what we found was the case. And the truth of the matter is yes, it is industry specific. And that's one of the things that when we talk to clients about is, if you're going to do a marketing campaign, be aware of who actually is going to look for your type of things and how do they find them, right?
Yeah.
Bulk mail, let's be honest, nobody looks at bulk mail anymore.
I don't.
When we go to the post office and pull the stuff out, 99% of it's trash.
Yeah. Yeah.
We don't even look at the little cards and stuff, but where do most people go now? They either go to the internet, they either Google something, they talk to their friends, or they go to specialized publications, right?
Yes.
So if you're in a specialty field, maybe a doctor or a lawyer or an engineer, maybe you need to look at a magazine that's specific to that industry where you're advertising your credentials in that thing.
Yeah.
But that's, if you're a beginning entrepreneur, that would be my first thing is don't buy into, because you're going to get a lot of solicitations from marketing companies to use their stuff.
Absolutely.
Don't just buy into their hype, because it's a great way to blow through a bunch of money that you as a startup can't afford to do. And you're not going to get the return on investment.
Well, Rick, this leads into what we were just talking about, right? Like, it's that important. I mean, I cannot emphasize enough. You've got to have the right advisors around you, or you will spin your wheels and you will spend your hard-earned money at poor decisions.
Yeah.
You just, you'll read something, you'll Google it, you'll read something out there, you'll say, well, based on this, it should work. And I get the logic. I truly do. I was that same person 16 years ago.
Yeah.
Okay? Guys, there's a better way. Okay? Spend the money, but spend the money with the right advisors. And I'm not saying this to advocate us. Look, you don't have to use us. You can use whoever you want. Do your research, find the right people, right? Find someone who's going to guarantee the work that they're going to do for you, right? That's very important. If they're not willing to guarantee the work that they're going to do for you, you need to go somewhere else.
Yeah.
Okay. But you also, that same guarantee that you place upon them, you need to place upon yourself. Did you do everything you were supposed to do? Right? So same thing goes for someone who's into fitness and trying to lose weight or get in the best optimum shape. Did you work out 5-6 days a week? Did you eat the right macronutrients? Did you get the right sleep? Did you rehydrate the right way? Did you do all these things? And if you're, so be prepared, right? Absolutely hold your advisor accountable, but you need to also hold yourself accountable too, right? Because at the end of the day, you're just selling yourself short, right? And that's why it's, when we bring clients on for this type of work, we're very, very selective. I need to know that they're committed to the success.
Yeah.
Right. Because if they're not, then it's more than just giving back their 110% of money. And we've never had to do that ever. It's just so deflating, right? Because I'm in it with them, right? I'm their coach. I'm their Bill Belichick, right? And they're the Tom Brady. And I'm here to help get them to that next level. But I only want to deal with serious candidates. So if you're not serious, this is not a right fit. I'll just be very upfront, not trying to be arrogant or anything like that. But we want people who want to do great. And those are people we want to associate with.
Well, and I'll give you an example. So 2 years ago, one of my long-term clients, who's a therapist, had been running her own counseling for a couple of years now, and called me up and was like, what do I do, Rick? Because I'm burning myself out and I'm barely making money, and I don't have any more capacity. What am I doing? And I flat out asked her, I said, how much time are you working in your business? How much time are you working on your business?
Boom.
Okay.
Yep. And
she's like, well, what do you mean? I said, how much time are you spending doing your own bookkeeping, running your own payroll, trying to figure out your own marketing strategies, doing your own billing? How much? And she was doing it all, right?
Yep.
And so we talked to her about it. And I said, you have got to stop spending all this time doing this. Give up some of your control over your business.
Have to.
Give up some of your control. Let others come in and help you. Yeah, it might cost you a little bit on the front end, but it will open so many more doors for you. And so what we started doing is I started showing her some opportunities for things. She moved to online counseling. She expanded her territory. She's now working in Pennsylvania and Florida and Texas.
Yep.
And she's gone from now not seeing any clients to only being the CEO of her company and managing a staff of about 40 or 50 other counselors, because she was willing to give up the control of her company to us and to some of other advisors who could help her grow her business the way it is. And we meet with her every quarter, and she is so much grateful to us about how much better things are for her.
I love that.
Right? That's what it takes. If you want to be as a successful person, you got to realize your business can only go as far as you can go.
Yep. Yep, absolutely. That's a wonderful story. And so you think about this lady, right? So now she's got 40, 50 employees. How many opportunities now, right, has she now created for other people who now work underneath her?
That's
She's
right.
created jobs, right? So this, like I said, this is personal to my heart. I love creating opportunities. I love to see people grow their organizations, not just from the financial aspect of it. I mean, sure, we live on an economic planet today, but I look at it from the opportunities and lifestyle and how we've created so much value in so many people's lives, right? And how many people we've touched by the notion of all these new opportunities that young lady was able to expand and create jobs and opportunities for other people to support their families and whatnot. Wonderful, beautiful story. And like you said, even when it comes to the tax planning, one of the things that make us a little bit different is we don't rely on just end of year, right? A lot of people just do their planning at the end of the year, right? So meeting with them quarterly, and it goes with the calculating the ES payments for federal and state if there is a situation. But you really need to understand what your drivers are, right? You really need to understand what your drivers behind your financials, and you need to start making critical decisions about your business that is based on those historical data, and then start making projections. And in addition to that, not all debt is bad debt, right? You need to learn how to, the power to be able to leverage that debt, right? To achieve other goals, right? So if, as an example, if, you have to take on some debt, and let's just say you're paying 6-7% interest, 8% interest, but the yield from that extra debt that you've now taken on is now 15%, you actually doubled. Well, that's good debt to take on, but you got to be careful. It's a slippery slope, Rick. You know that. So, for us, we really want to optimize your business, and we dive deep. I tell you, we dive real deep. A lot of times, a lot deeper than most people want us to. We find out some things they don't want us to find out. But look here, we're not telling those stories. We're here to take you to the next level. And the thing I love the most, Rick, what you just said, is working on the business, not in the business.
Yeah. No, absolutely.
So great data, great information we've talked about. I know we've kind of taken a little bit of different steps on this go around. So one of the things I want to talk about, Rick, if you're okay with it, unless you want to still talk on this.
No, I'm good.
Okay. If you were self-employed, let's just say,
okay,
and during the COVID season and you got sick, you might have some sick and family credits that are available to you. And some of those can be up to $32,220, Rick, which is pretty substantial. In order to acquire that, you need to file, it need to be acquired on your 2021 tax return. So if you accidentally overlook that, guys, and you forgot to do that, it's not all lost yet. Okay. You're going to have to go back and file IRS form 7202. And from there, it will roll up on your 1040X. You need to get that filed. Okay. To help you determine what those expenses are and what credits that will be available to you, you need to go back and you need to look at your emails, your vaccinations, your medical records, your school records, all your documentation that is correlated to when you had sick under COVID. Okay. Now, realize you don't need this information to file with your taxes, but if you're ever audited, you're going to need that information to supply how you came to those calculations. That's something that Rick and I can help you with. It might seem a little cumbersome for you, but realize that we're pushed up against a deadline right now, Rick. You know that, meaning that you have until April 18th, 2025 to have this filed.
Why is that?
Because there's a 3-year statute of limitations, right? So once that return is filed, you have 3 years to go back and amend that return that has already been filed.
Is that for all returns?
Not for all returns. Now, if you filed an extension, you have an extra 6 months to go correlated with that.
All right. So it's really 3 years based on when you filed your return.
That's
when
correct.
It was due.
That's right.
All right. And so, the basic premise for most people is going to be April 15th, because I think, was it like 75% of people filed before the April 15th deadline?
Yeah, and when that, like I said, it was April 18th on this one. The reason, let's just tell the reason why it's not on April 15th is because that deadline falls on a weekend, and it just pushes that next Monday. So, go ahead, Bill. Sorry.
Well, no, I was gonna actually harp on that, because everyone always assumes it's always the 15th. No. Sometimes there's a federal holiday that falls right in that time frame.
Yep.
And I've seen it. We've actually had it as late as April 20th in some years, that based on the weekends and the federal holiday that comes in. But yes, for filing purposes, the 3-year statute of limitations is applicable. The problem with that is also that if you miss that and maybe you were due some money back, you miss that 3-year window, you lose that money.
You do. You can still file, but you just don't get the refund.
That's right.
That's right. 1099s for corporations. Are you familiar with that? Like, there's always been you don't have to do it, but there's certain little caveats you have to.
There is. I mean, so I will say, we in the industry have always taken the approach of if you're an S corporation or a C corporation, you don't really file 1099s. You're not required to. But I think most vendors still ask you to fill out the W-9 to send over to them, and you might still get a 1099, but you're not required to them. And the reason why is corporations keep a set of financial records that encompasses all revenues, right?
Yeah.
So 1099s are really around the whole contractor construction, right? That if you're a contractor, you typically are a sole proprietor or even a partnership, and you may or may not be keeping a set of QuickBooks or anything like that. And so this is a good way of you determining how much you actually earned, right?
Yep.
And then the amount has changed. Now it's $600. If you've earned $600 from any one customer, then that 1099 is supposed to be rendered to the individual or to the business. But, I've seen them issue for a lot less than that, honestly, because a lot of companies will just, if they issued you any money, they're going to send you a 1099 regardless.
I'll be honest, I never had an issue with it. Years ago, some of my bigger clients, they might have paid me $10,000, $12,000, whatever the numbers were, right? And they said, well, Jake, do I need to issue you a 1099? And back then I would say, no, you don't have to. But if you want to, by all means, go ahead. It doesn't matter, right? So you got to look at it. So if you just hypothetically paid that vendor $10,000, and you issue them a 1099, but when they reported on the revenue for the year, if they have, let's just say, an arbitrary number of 200,000, well, that more than covers the 10,000. So I never cared because I reported 100% of my revenue anyway. It didn't matter. Right. So I would always say, well, technically you don't have to back then, but if you want to, go ahead. It's fine.
Well, and the reason why businesses like to do it is it justifies their expense, right?
Absolutely.
They want to be able to take the deduction. And if anything ever comes into question on their side, if they were to get audited by the IRS, they can go, look, I issued 1099 to JL.
Yeah.
Right? For 10 grand.
Yep.
That's why I took that $10,000 deduction.
Absolutely.
So you need to go talk to JL about claiming that income.
Yep.
That's really the other side of this. We're responsible for reporting the income, but they want the deduction as well.
Yep.
And so that's the reason why a lot of people get to where they like to issue the 1099s. Now, the question is, which 1099 do I issue? Because there's a bunch of them. There's a 1099 NEC, there's 1099 MISC, there's 1099K, there's a 1099S. And each of those has a different code that they fall under. Most people are going to get the NEC, which is a relatively new one because up until 2018, everything came on the 1099 MISC, right?
Yep.
And then 2018, we had some changes, and they separated what is NEC represents non-employee compensation.
Yep.
Right. That's what that NEC represents, okay? And so they split, if you are a contractor, that money came off of the MISC document, and now you're reporting as compensation. The MISC now is for your typical like royalties, your rents, that other income that's not really for you doing a job. You're just getting paid for some miscellaneous service, right? Mm-hmm. And so now that's what those 1099 MISC are really for now. And it can be for a whole bunch of things: royalties, rents, other income. It could be for medical payments. It could be for legal settlements.
Yes,
okay?
yes.
So those forms still get reported on those types of things. The NEC is going to be your contract labor, those types of things. So and again, I'm going to reiterate the $600 flat amount. The IRS is kind of picky on this. If you paid $600 out to a contractor or more, the expectation is that you file it. And to be honest, there's a box on every form, whether you're filing as a sole proprietor on your 1040 or you're filing a corporation form. They ask, were you required to issue 1099s? And if you were, did you file them?
Correct.
Right? Correct. And that is a great way to have something disallowed if you are audited. The IRS will ask you, how were these payments made? And did you file the 1099? And if you didn't file the 1099, they will disallow those deductions.
Absolutely. And one thing I want to just kind of hit on here as well. Look, Rick's hit on the $600 threshold. That's a $600 threshold for issuing the 1099. If you've received $550 and the company didn't issue you a 1099, you still got to report the $550 as income.
Right.
Under Internal Revenue Code, Section 61, you have to report all income deemed from whatever sources you've received. Okay? So it's not, a free pass here just because you didn't get a 1099.
Yeah.
If someone paid you for any services or products or whatever you did, any business work that you have done for that individual, any earned income, you have to report that as income. I don't care if it's for $1. Technically, in the IRS's eyes, you need to report it, guys.
Yeah. And that doesn't matter what the form of payment is either.
No.
If it's cash, check, you got a credit card.
Right. If someone pays debt for you.
Even cryptocurrency payments, which is
Yes.
the new red flag for IRS
Yes.
is are you getting paid and receiving cryptocurrency? That all those transactions have to be accounted for, right?
Absolutely.
And then the other side of this is also keeping in mind that some of these other things, especially because the real estate market is so hot right now, is that form that you get when you sell your house and it's more than $250,000.
Yeah.
You still have to file that with the return, even if there's no capital gain.
Correct.
That is represented.
Even if you lived there as a primary residence for 2 of the last 5 years, you still have to.
Yeah. And here's why, because that form gets filed with the IRS.
That's right.
And they're expecting you to file something about that form.
Absolutely.
Okay. So that 1099 has your social security number, and the IRS collects all these documents, whether it's a 1099B, which is a brokerage statement, or again, these ones for house sales. They all accumulate on a list with the IRS of every form that gets filed with your social security number. And when you're filing that tax return, they're checking the box. Did they incorporate this? Did they incorporate that? And if you miss filing one of those because you think, well, I didn't have, let's say you got a 1099B and it's all zeros, right? Or maybe you had a little bit of a loss and you went, I didn't file it. Well, guess what? They will come back and send you a letter that says you didn't file this. And because you didn't file it, we're going to assume there was a gain on it. And we're going to estimate what that gain was. And we're going to charge you tax for it.
It's ironic you said that, because right before our little podcast just a while ago, we had a client that just came in, met with one of our tax managers here. And, he was trading in cryptocurrency. And so whoever filed his taxes in 2022, he was issued a notice by the IRS because he didn't report the sale of his cryptocurrency. Okay. Well, the brokerage firm that housed that cryptocurrency, they only reported the proceeds. They didn't have his cost basis in there. Okay. And so what happened was the IRS, from their perspective, when they received that document, it says, oh, you had X amount of proceeds of cryptocurrency that you sold, but they had no basis to go off of that, Rick.
And they assume zero every time.
And they assume zero. That's correct, right? So then he brings in and goes, well, here's my basis. Here's what's going on. What's your advice? And I said, well, we need to either go back and amend it, send him a letter or something of the regard, but we need to address it. And he goes, well, I mentioned to my previous CPA that I had some cryptocurrency. I said, well, why didn't he ask? This is what I'm talking about, guys. This is what sets us apart, right? It should have never came to this. Look, there are instances, and we do have clients, and everybody has clients that gets notices. I'm not trying to say that doesn't happen. But this was an easy one right here.
Yeah.
You understand?
Yeah.
And not only did it happen in 2022, I looked at him, I said, did you just file your 23 or you need help with 23? He said, no, we've already filed our 23. I said, did you do the same thing in 23? He says, yeah, with the same guy. I said, well, my advice is let's be proactive. Get that return amended before you get a notice and cut the bleeding off for all the interest and penalties that's constantly accruing to go with it.
And this kind of leads into one of, I think, a lot of clients' pet peeves is having to answer all the questions, right?
Yes.
And before we move on, let's just talk about that real quick. When we, as preparers, right, when we send you out this 30-page organizer, we're not just doing that because we like you to fill out paperwork.
No,
okay.
no.
We want you to answer those questions, because if you're answering every one of those questions, we can help you head off getting a letter from the IRS, because those questionnaires have these kinds of questions. Did you trade in cryptocurrency this year? Did you buy some? Did you sell some? Because if you mark yes on that,
Yep.
I'm going to follow up and go, I need the statements for it so I can make sure it gets included on your tax return.
Yeah, absolutely. That's and I don't mean to keep harping on it, but that's the difference between having an advisor and someone who's just doing compliance work. Sure, you'll find those accountants that are bottom of the barrel that just want to do the return and have you in and out, and you see them once a year. That's not who we go after, right? We want we want to work with those people. It's not just numbers for us, it's families we represent. It's businesses we represent, right? We understand that they're, like I always say, it's people over profits, right? And so I can't tell you, you can probably tell more than I can, because you write down most of the bills that we'll spend more time than we actually even bill a client, right?
Yeah.
It's just doing the right thing.
Yeah.
And so, we might say, oh, you're going to get X amount of hours, we're going to spend X amount of time with you, but I will be completely honest when I say this. You're going to get a lot more than that. It's like, there's so much time, that we spend with our clients that we just do it just because it's the right thing to do.
Well, it's just like any industry. Nobody can see behind the curtain and see how much work is actually done, right?
No.
And I don't care what industry you're in. Nobody understands, unless they're in that industry, how much work really goes into that job. But I can assure every single person that comes to us, when we give you our quote, the cost a lot of times is way more than what that quote is.
Absolutely.
Right.
Absolutely.
But it's not because we've just cut our prices down or tried to make it cheap for everybody. It's because we want to do the best job that we can. Yeah,
absolutely. I mean, just to kind of, hit on that a little bit more is, all the firms that I worked for, and I know you were the same way, Rick, is we all kind of mimic ourselves after the firms, or the greater firms that we worked for, we had the greatest impression under, right? And the same thing for me when I started this firm. There were some really firm partner owners that I worked under that I thought very highly of, right? And I wanted to mimic my firm after them. But even once you get in the throw of things and you realize that business is constantly evolving, right? And you realize that there's always a better way to do things. And while they were great, you want to be even better. And so, and like I say, for me, it's always just been spending more and more time with the clients. Quality over quantity every time, Rick.
Sure.
And we've never wanted to be just one of those that just mass produce.
No, I mean, look, and I always say this, we are not the firm for everybody.
Nope.
We are not the firm for everybody. We are not we want every person in the world to come to us.
No.
Because, to be honest, we can't help everybody.
We can't.
There are and I'll say, large number of clients that they're just the traditional family. Mom and dad both work. They both have a W-2, maybe have a couple of kids, but that's really all they got going on in life.
You have to be careful, Rick, with when you see even people who market or advertise out there that, oh, I've represented hundreds of thousands of clients. Did they? That's just not humanly possible, Rick. It's false advertising.
Well, I'm going to go off on a tangent here. How many clients have we picked up where they went to a CPA or an EA who promised them the moon? Mm-hmm. Who said, yes, I can find a whole bunch of deductions for you, and I can do this and this and this for you. And when you look at the return, they're taking stuff that they had no business taking as a deduction.
We're fixing those mistakes.
Yeah. And then they're wondering, well, why did this CPA do this for me? Now I'm in trouble with the IRS. Why'd they do it? And I said, because they are the kind of person that has no integrity.
Mm-hmm. Mm-hmm.
They know at the end of the day, they're not the ones that are going to get in trouble with the IRS. You're the taxpayer. You're the one that's going to get in trouble.
Yeah. So when who you're working with, they need to represent you fully.
Right.
And make sure that you keep your ass out of a crack. I hate to say it in that capacity, but
I routinely sit down with people that come in and ask for help, and I will look at them straight in the face and go, you don't need my help.
Yeah.
You can do this on your own. Mm-hmm. You don't need to pay my prices when you can literally go down and do TurboTax yourself.
Yep.
And if you need help, call me. I'll walk you through it step by step, free of charge.
Yep.
Because I don't feel right charging someone our prices when all they have is a W-2.
Yeah, I agree. One of the things that comes up, Rick, is early withdrawals from IRAs.
Yeah.
Okay. And look, man, there are a few exceptions that are out there. We're gonna hit on them right now. That, most of the time, if you make a withdrawal from a retirement account, especially if it's a tax deferred account and you're under the age of 59 and a half, you're going to be hit with a 10% penalty under most situations, right? But there are some certain areas, like for instance, if it's your first time to purchase a home, you can withdraw up to $10,000. It's a lifetime limit for a qualified home acquisition. Let's say you might want to, you're going through a birth of a child or an adoption. The expenses that are related to that up to $5,000. You can utilize those funds on the withdrawal and not pay the penalties on. If you have some medical expenses that exceed the 7.5% of your adjusted gross income, you can use it for that. If you're going to have some substantial periodic payments that you're making, you can withdraw and utilize it for that as well. And then higher education, if you need to use it for higher education for you, your spouse, or your children, you can use penalty withdrawals for that to make sure you don't pay penalties on that as well.
Well, I'd like to harp on that last one. You talked about the periodic payments. What would be a great example of that? And let me give you what that is. IRS Code 72T
yes,
allows you, prior to retirement age, to pull out of an IRA specific sets of monies over a certain amount of time. And you can now take that money and roll it into a Roth IRA.
Correct.
Yeah, you have to pay the taxes, but you avoid the penalty. Mm-hmm. If you think you're getting close to retirement and you want to get in retirement where your money isn't taxed, this is a great time to start pulling money out of that IRA without having the penalty. Mm-hmm. Keep it in a lower tax bracket.
Yep.
And bleed that IRA out into a Roth, then retire. Now all your money's sitting in a Roth that you now can take out tax-free.
Absolutely. Look, and so when we're talking about traditional IRAs and Roth IRAs, the ironic thing is the other day, it was probably 2 or 3 days ago, I had a good friend of mine and he texted me and he was asking me, should he be invested in a traditional or a Roth? And I went on to advise him. I'm not going to get into the specifics on that because that's personal for him. But look, your advisor should be working with you on this. And it's never. I hate cookie cutter things, right? Everyone's situation is different based on their adjusted gross income, whether they're married, whether they're single, whether they have kids, whether they're head of household, whatever their filing requirements are, whatever their goals are, what they're trying to accomplish. What they might be coming into a large sum of money down the road from inheritance. Every situation is unique and different in itself, right? And so to me, I was able to properly advise him. We worked through it, but that's what, like I said, once again, that's what makes us different, right? We don't just, do it like that and give an answer and it's the same answer for everybody. We take down intel, right? We dive deep into what's going on, what that person's trying to accomplish, and then devise a plan that is best suited and works for them.
Yeah, I call it lazy tax advice. Lazy tax advice is just max your IRA, your 401k, your SEP IRA, whatever it is, just max it out.
Yep.
That you'll get the biggest deduction for it, but just max it out and then I don't have to do anything else. That is lazy advice.
That is.
Because you haven't taken the time to understand the situation. What if they, from a financial standpoint, can't afford to max it out? Or what if they haven't planned any emergency savings and need to start building that up in case there is an emergency? If that emergency happens, Hurricane Beryl comes through.
You know who I see gives that bad advice the worst? At least from my experience, financial advisors.
Yeah.
How many to me, not all of them. Look, there are some really good financial advisors out there, but the lion's share are dirty car salesmen to me. Honestly, they will sell you any financial instrument so they get their commission, and that might not be the best situation for you.
Yeah.
That is not their area of expertise.
Yeah.
Okay. They don't need to be even giving you advice on that.
Yeah, I hate the financial advisor that will say, you're going to get a tax credit for this, or you're getting a huge deduction for this. Maybe, maybe not.
And that should never be the sole reason as why you even purchase the investment vehicle.
Right.
It should be multifaceted. There should be reasons behind it. Is it going to give you the proper return on your investment? There's so many different things you've got to be looking at. And it just infuriates me when they overstep their reach there and try to say, well, you just need to maximize this out, or, you need to set up a defined benefits plan. And I don't care what it's going to cost, and we're going to give you a terrible return on your investment, but these are the things you need to do because it's going to give you this massive tax deduction.
Yeah.
Well, maybe it didn't really do anything because you were in a lower tax bracket. So it was diminishing returns on what it was actually getting you, right?
SEP IRAs are notorious for this. The financial advisors love to set them up for people that are in S corps.
Yep.
You're going to have this SEP IRA, and you're the only person in it, so you can max fund this thing. Yep. You're going to get a $60,000 tax deduction.
Yep.
There are so many qualifications on how you set that up, whether you can even contribute to it or not.
Yeah.
And you may be paying tens of thousands of dollars for this platform that you can't even fully utilize.
Yeah, absolutely. Well, sorry, we got a little bit off on that, but let's if you don't mind, let's focus on some of these things.
Come on.
So if you're terminally ill and you need to make withdrawals for that, there's an exception there. They have it waived. Post-death withdrawals, amounts withdrawn after someone has passed away, might not be subject to penalties. If you need some long-term care, and that's going to happen in December 29th, 2025, you can take some for that. For disability purposes, there can potentially be one for that, as well as a disaster recovery. We just went through one with Hurricane Beryl right here. That just hit right here because we're in the Woodlands, Texas, so the Houston area. We got hit pretty hard because there's a lot of trees up here. So if you are one of those candidates and you had some damage at your house, there might be some potential you could. We need to sit down with you. We want to calculate everything. I just don't want to give you fully blanketed answers on this. You could potentially have the waiver associated with the penalty for withdrawal on that, up to an aggregate limit of right around $22,000.
Well, and there's been some guidance now put out by the IRS on Hurricane Beryl and some things that are going to help some taxpayers as well.
Yeah, and we'll get into that a little bit later, okay, about those updates. If you don't mind, we'll hit on the last 5 elements here, Rick, if you don't mind. IRS levies, withdrawal to pay IRS levies. You can use that. This was something that I did some research. I never heard of this before. Domestic abuse victims, as of January 1st, 2024, if you were a victim of a domestic abuse, you can take up to $10,000 withdrawal from there and not have to pay penalties. That's new. Military reservists, any type of emergency expense, withdraw up to $1,000 for emergency, and health insurance premiums for compensation of up to 12 consecutive weeks for that.
Well, so that emergency expense, that's another reason why, and I hate to go back and harp on this, why it's great to plan out how much should you be putting into your IRA, right? Because if you're, again, max funding that thing and you've got no extra on the side, how much will $1,000 help you if you had a tree go through your house, right?
Not much.
Not much. And that's all, but that's all you can take out of your IRA is $1,000.
Yep.
And so that's why it's really good to get with one of us to help decide how do I properly structure how much I should be contributing and how much should I be saving.
Yeah, absolutely. Rick, this next topic I want to kind of hit on, if you don't mind, is something that I know you and I have talked about because how much you like Disney, right? The timeshares and everything associated. Creating a business deduction for your timeshare, the deductible entertainment facility aspect.
Yeah. So, if you are familiar with the Disney company, they have their own timeshare. It's called DVC. And it's in the state of Florida, and Florida's got some pretty strong regulations around timeshares. And I will tell you, timeshares have a notorious background with them, and rightfully so. There's a lot of crappy companies running timeshare companies. I would say Florida in and of itself is probably the greatest state to own a timeshare in, because they recognize that is the biggest part of their revenue stream is tourism and having people come into the state. And so they've put a lot of regulations on how timeshares have to be structured there. Disney in itself has kind of incorporated their own way of doing it to the point where there's an aftermarket ability to be able to sell those timeshares, which is not always possible in most timeshares. Usually you get into it, you can't get out of it. And if you can, you don't get anything from it.
Yeah.
It's usually $1 and you're walking away from your contract. There's an actual aftermarket ability for it. So why is this important? Well, if you are a Disney fan like I am and you buy into their timeshare program, maybe you decide to use that in your business. Maybe you decide to use that as a way to reward employees.
Yeah.
Right?
Yeah.
Hey, I want to give my employee a week at Disney and I own a timeshare there. They can use my points. Can I use that as a deduction? Yeah.
You can.
You absolutely can. Right? There are all kinds of ways to use your timeshare to do different things. Right? Now, how does it work? Well, your primary benefit has to be to an employee. It can't be you. You can't take a vacation under your timeshare and say, I'm writing it off as a business expense. Nope. It has to be employees.
And I can't as your partner.
Right. And that's the other thing. It can't be if you own more than 10% of the business, you are excluded from being considered an employee, even if you're an employee of your company, C Corp, S Corp, right? So that's the first thing. All right. The employees have to use it more than you do. That's the second thing, right? So let's say you have a timeshare that's up for, you have 2 weeks that you're allowed to use it, right? Well, if your employees use it for a week and uses it for a week, that doesn't count. It has to be more. The employees have to use it more than you do, right? So if you have it for 2 weeks, let them go for 10 days. You go for 4 days. Then you can qualify their 10 days as under it, right? It also has to be what's called non-discriminatory, which means it can't be for like a reward for your managers only, right? It has to be available for every one of your employees, right? Now, you could set it up, great way of doing it as a reward. Maybe you've got a sales thing and you're like, anybody in the company is eligible. If you're the top salesperson for the company, this is the reward. Okay. But it has to be eligible for every employee in the business. It can't just be for a select group of people in the business, right? And then you got to make sure with everything you document.
You got to document. Document is key. There's a second methodology that you can use with this. If you're going to use it as compensation, you can treat it as timeshare as compensation to the employees. But realize when you do that, it's going to create taxable compensation. It's going to roll up on their W-2. Okay. When that occurs, though, you may be able to still deduct the costs incurred by providing the benefit. You can still utilize things such as depreciation, Section 179 for expense in furniture and appliances and things like that through it. Me personally, I don't like method 2. I'll be honest with you, because it sets a sour mood in your employee's mouth. I'll be honest with you. If someone's earned something, and I get it, right? If someone's worked hard, you pay them a bonus, whatever, and they have to pay taxes on it. But, when you say, hey, why don't you go vacation at my timeshare? Yes, there's absolutely economic value there. I'm not arguing that. But do they really want to go pay taxes on something like that? Like it's tough, right? Right. Like if I pay an employee $1,000 and they have to pay 20% in taxes, well, they have the financial resources to pay for that.
Right.
But if I say, hey, you can go use my timeshare or your timeshare in this situation, and you don't actually give them any monetary funds, right? You just give them economic value. Now they've got to come out of pocket for extra resources to pay taxes on that.
Yeah, the only time I can think that this would make sense, and having been in this position before where you can win a prize from your company and get to go on vacation, it needs to be of such great worth to them that it's like, this is a once in a lifetime thing that we would never do unless we did it. And I'm willing to pay the taxes on it. Right. And so let's take some arbitrary number. Let's say you get a timeshare somewhere in, say, like Fiji. Okay.
Well, if we're talking Fiji, I might pay the taxes on that one.
Okay. What would it cost between plane tickets and hotels? $15,000-$20,000.
Oh, sure,
right?
Sure.
Well, if I would never I'm never going to pay that personally.
No.
Right. But if I want it, would I take it and would I pay the taxes on it? Yeah, because it might only cost me $2,000 or $3,000 in taxes.
Sure.
To take this extravagant vacation that I would never get to do. But if you're just talking, hey, here's a week up in Colorado, right? And I'm going to put $4,000 in comp on you for it. I don't want that. I don't want to pay the taxes for that. I could go do it myself.
Yeah, exactly. So it's a slippery slope, guys. And that's what we get into. You got to look at things not just from a tax implication perspective, but how does it impact your employees in this situation, right? What other elements should you consider when making a determination on something like that? So we're going to pivot from there. We're going to start talking about shutting down specific organizations. And the first one I'm going to talk about is when you shut down an S Corp, Rick. One of the ways is through a stock sale. And in most of those situations, especially if you've owned that S Corp for longer than a year, it's going to be long-term cap gains in most of those situations. So you're looking at 20%. Now, if you were a passive owner in that business, though, realize you could be subject to net investment tax, which is another 3.8% on that. But if you actively participated, you would be exempt from the net investment tax. How about if it's an asset sale? How would that be taxed, Rick, if you don't mind?
Well, so the difference is going to be you're basically selling the assets and any associated liabilities in there. Most of the time, you get to keep the cash, but sometimes they keep the cash and the AR. It just depends on how it's structured. But it's all based on taxable gains and losses, capital gains, that sort of thing. And so this is where you really have to keep a good idea of what your basis is on all of your assets.
And if you have recapture for fixed assets, fully depreciated.
And if it's depreciated, you're going to recapture some of that depreciation. Yep. So you may have a little bit of taxes on that. And depreciation is not cap gains, that's ordinary income. Correct. So you got to keep that in mind as well. But you're talking about, your capital gains, everything's going to fall under section 1231 on this. Some of these gains could be 20%, but they can go up to 37%. Okay.
It's a big difference.
And it's a huge difference, right? So this is where you need to really work with your preparer to make sure that you're classifying these assets properly in your S Corp, and then pulling it out. Here's the other issue with a lot of this. I will say a lot of our clients run into this. They keep their personal vehicle as an asset of the business.
Yes.
Well, if I sell that business and I sell those assets, I want to keep my car. But now I got to pay taxes on my car.
Exactly.
Because I sold it.
Well, and when someone sells their business, right? If you're talking about shutting down your business and you sell it, oftentimes the taxability, the tax implications is going to be associated with the shutting it down and the sale is going to be illustrated in the buy-sell agreement.
Yeah.
Okay. So you got to be very careful how you craft that.
Yeah.
Right. So if you, like Rick was alluding to, if you craft that in an element where if you craft an element that is based on asset sales versus stock sales, you're going to pay more in taxes.
Yeah.
I mean, I don't even have to look at the books to tell you that's what's going to happen, So you got to be very careful with that.
Now, if you work with a good attorney, they can word things to apply a purchase agreement around specific assets. A good attorney will say, let's say it's $1 million business, and they'll go, well, your fixed assets really only worth about $200,000.
Yeah. Yeah.
So I'm not applying all $1 million to that $200,000. I'm only going to apply $200,000. The rest of that's going to go towards goodwill.
Yep.
Right.
Yep.
And that's a great way of avoiding paying more in taxes than you should on certain items.
Yeah, and let's talk about for a second, Rick, if you've got, let's just say it's an S Corp and you've got two members or shareholders, they'd be shareholders in this regard for federal purposes, and one individual was the individual who provided all the capital. The other individual was more of a sweat equity, and then there was really no retained earnings because all the earnings was actually distributed out. And so, if you get to a point where the basis has been completely eradicated, zero or even negative in this regard, and you take a distribution, now you're going to have what they call long-term capital gain distribution tax associated with that. So you got to be very careful, and you need to look at your equity positions for your partners or shareholders in this regard, to make sure that there aren't any additional taxes that are going to be now applied because you let the basis run dry in some of these partners. And then I would say also from a compliance perspective, when this sale transpires, it's going to be on Form IRS $85.94 for the asset sale. And some of these, look, let's be honest, Rick, some of these aren't just all cash deals. Some of these are installment sales, right? And now you have to report that income over an installment of the sale, whether that be a 3-year look back, a 5-year, whatever that time frame is, right? You have these periodic payments that are actually that you're going to be receiving now down the road upon the sale. So you need to make sure everything is filed properly. And structured properly, so A, you don't pay more in taxes than you need to, first of all, and B, that you don't shed any negative light and have the IRS crawling up your butt.
Well, on top of that,
for something that's filed incorrectly.
Yeah, when you have an installment sale, one of the things you have to be careful of is, are you going to be required to perform any services for that company going forward? Yep. To, maybe there's a retention clause where it says you must help retain clients for 2 years to earn out the rest of your buyout. Well, that's an earn out. That's not part of the purchase agreement. And that has to be segregated. And those are subject to ordinary income tax rates.
Correct.
And you can end up paying a lot more in taxes on these earn outs than if it was a pure purchase. Yep,
absolutely. And look, guys, the same thing so now we'll just kind of transition, if you will. Same thing goes for sole proprietorships. If it's an asset sale, look, it's going to be the same element per se, because basically these businesses that were S corps, these are all pass-through entities. So whatever the gain is, it's rolling back to your personal. So you do these asset sales. It's going to be the asset, which is what I call the net book value that's now associated with it. When the net book value, for you guys that don't know what that is, it's originally your purchase price less any accumulated depreciation, subtract out the sale. And so whatever that difference is, you're going to, you could potentially have some additional gains that's associated with that, right? And like you said, some of this is going to fall under 1231 gains on this as well, Rick.
Yeah.
So you got to make sure that everything is structured properly. Look, we can go in and carve these up as much as we want on this podcast today. And I think for the most part, it's just eyes are going to glaze over on some of these deals.
Yeah.
And I don't want to, I know we're going to hit on all these in great detail. I don't want to hit too much in detail, Rick, because I want to keep everybody's attention. You understand what I'm saying? And there's so much information we got to cover, but it's going to be still very similar to what you see with an S corp or any one of these pass-through entities. Same thing for a partnership and stuff like that too.
Yeah, I mean the codes are pretty straightforward on all of them.
Yeah,
you're either going to be 1231, 1250, but really the structure of your business doesn't matter when it comes to these sales.
No,
because ultimately it's going to end up rolling onto your personal return.
Yeah, absolutely. And when we're talking about these asset sales are going to create capital gains, and some of these capital gains could be reported on 4797 Sched D for these asset sales. The next topic was partnerships. Same situation. Basically, one partner buys out the other. I don't know if there's something you want to hit on, Rick, and talk about some of this. I want
to harp on this because this is where making sure you have a good operating agreement comes into play. Because maybe it's not a one partner buys another partner out, right? Maybe it's an outside partner comes in and buys one other partner out.
Very true.
Okay. Depending on your operating agreement, you may have just terminated your partnership, even though there's still two people in the business.
Yeah.
That partnership was designed for the original two people, not a third party to come in.
Yeah.
But vice versa, if it is a partner buying the other partner out, if there's only one person left, there's no longer a partnership.
No.
You just terminated your partnership. So be careful when you're structuring these buys and sells, because you may terminate your entity without realizing you're terminating your entity.
Yep.
And then now you've got to go reset up a new structure.
Yeah, absolutely. So one of the things I want to talk about is roof replacement and the write-off of an old roof. You got to be very careful on some of this stuff, Rick, because you got to look at it and go, is this a repair? Is this a replace? Is this a capital improvement? And for most of these situations, it's a capital improvement that's associated with that. But there's certain legislation out there that will allow you to calculate and write off a good portion of the depreciation, and some of it you can front load, right? And so I look at it from this perspective: the faster you can write something off, It's time value of money is what that is. Okay. So $1 today, everybody knows this is worth more than $1 tomorrow, the next year. And especially we know this very well the last couple of years with all the inflation that was going on, right? We were seeing inflation at 10, 11%, right? So it's the same thing that goes for roof replacements, is making sure that you can write it off as quickly as possible. Because if not, now look, so there are certain situations that you might want to say, okay, and this is where the kind of the tax planning goes into effect is, you might look at year 2 or year 3 for this rental, let's just say, that you expect to add a couple more houses or you expect your income to be substantially higher, and you might want to defer that deduction.
Right.
That's where it's very critical, guys, to make sure you're working with your advisor to make sure that not only are you looking at historical information, but you're also looking at projections or pro formas of where things are going to see, does it make sense to expense it out? Under time value money, yeah, it absolutely does. But what is your financial position going to be 2, 3, 4, 5 years down the road, Rick?
Sure.
Well,
and I think you mentioned the best part of this is this only applies to rental properties.
Yes.
Right.
Yes.
So if you're just a plain homeowner, you don't get to write that roof off.
No.
But yeah, if you've got a rental property, for any major capital addition, you need to get with your preparer, because you may be doing a cost segregation study. You may be doing some other things to see how we can expedite some depreciation. But you need to get with them to understand what the impact is today and tomorrow.
Yep. The next topic we're going to talk about, something that I've dealt with before.
I think I have too.
I've dealt with it for a few clients, actually.
Yes.
Not that we have done it, but we have had clients that, so whoever they were with before, their previous CPA, and I don't really, honestly, I don't think I've ever seen it with a CPA. I've seen it, and maybe you have. I've seen it with these payroll processing.
Well, the payroll processor that I dealt with was a CPA, but she was not running a CPA practice. It was purely a payroll processing company.
Okay.
But yes, I ran into this one instance with them.
Yeah. So what do you do if you're a business owner and whoever's processing your payroll doesn't actually pay your payroll taxes for you, instead embezzles that money, and then, I mean, they always find out, guys. It's a year, 2 years, 3 years down the road. You're going to get notices that your payments don't tie back to your 941s or like nothing's tying back here. And they're going to say, oh, now you have all those additional penalties and interest. And you're thinking to yourself, well, I know that the money came out of my bank account. I was assuming that it went to go pay payroll taxes. What happens? And in this situation, there was a guy named Rodney Taylor entrusted his corporation's accounting and bookkeeping to a guy named Robert Gard, a CPA, over several years. Mr. Gard embezzled between $1 and $2 million, including payroll taxes. What position does the corporation or the business owner have in that regard, Rick? Do you want to elaborate on that?
Yeah, well, so before we even get into it, let's talk about why this becomes a problem. Because if you ever run payroll, you recognize whether you're doing it through a small firm or a firm like ADP, right? You just see really 1 or 2 lines come out of the bank account that just say payroll and payroll taxes, right? But they don't say to the IRS. They usually just say to ADP or to that payroll processor. And unless an employee complains that they didn't get paid, you have no way of knowing that those taxes aren't being remitted, right?
No, you don't.
And so until you get that notice from the IRS that says, hey, we don't see where you've actually made any of these payments. Because in this particular case, this CPA was providing 941s over to be signed, but not actually paying the taxes. And the 941s were being filed because the IRS had them, but no taxes ever got paid.
It's mind-boggling to me, that these CPAs and these individuals don't think that they're going to get caught. I mean, you're in this industry. You know you'll get caught, Rick.
Well, and that's
just crazy to me, but it happens so frequently.
Yeah, and that's so what ends up happening is you get this notice in the mail, and then you go down and you're like, what's going on? And what typically happens with these people is they go, well, let me look into it because I know I made the payment, and they're buying their time. And in my particular instance, the person disappeared. They took on a permanent vacation to an island with a boatload of money. And the IRS, what happens? The IRS doesn't care. They don't care that you got stolen from. This is important for everyone. Let me tell you something. The IRS does not care that you got stolen from. In my particular instance, you know what the IRS told us? Go sue the payroll processor to get your money. Before that happens, you need to come up with the taxes you owe us because we're going to start levying your business.
Yep.
And they did. For hundreds of thousands of back taxes that did not get paid, and the client went out of business because they couldn't afford it. Could not afford the back taxes that they thought they had already paid, and they had.
Yep.
It just didn't get to the right place.
Scary.
And so you need to be aware. You are ultimately liable, not the payroll processor.
Yep.
You as the taxpayer are liable for these taxes. And if they abscond with your money and you don't catch them in time, that money's gone and you could be out hundreds of thousands of dollars.
Well, Rick, this gets back to what you said earlier about having integrity and character.
Yeah.
Okay. Look, you're always going to be able to find somebody that can do the work cheaper. Is the quality going to be there? Are they going to have the integrity, the character? Are you going to have to deal with, let's be honest, shit like this?
Yeah.
Because that's what that is, right? Look, man, who's ever doing your taxes, your accounting support, your CFO guidance, you don't want to deal with these issues. Trust me. You might save a little bit of money on the front end, but look, man, you are building this massive, massive organization that you want to thrive and do well. You better build it on a solid foundation. Because if you employ individuals like this, and obviously you can't vet everybody, right? But what I always see when these things happen, it's when someone was penny pinching to hire the cheapest person.
Yeah.
Right. And so when someone is so cheap, it's like so almost unrealistic that they're able to operate at such an inexpensive rate. There's a reason, because they plan on embezzling.
Yeah.
Right.
Yeah.
Like, let's be honest. And look, I'm not trying to say everybody who performs work, at a very inexpensive price is going to do that. But I ain't never seen it happen on someone who's charging a reasonable rate. Have you?
No, and that's the thing is, you got to be careful with these people that come out and they want to do it for, payroll every month, $9.99, right? And you're like, well, nobody does payroll for $9.99. Well,
No.
Of course not, because they're not actually running your payroll. Your employees might get paid, but your money may not get paid to the IRS.
Yep.
And the problem is, the IRS doesn't wait until the first payment is missed and send you a letter. This happens years down the road. 2-3 years, and the IRS finally wakes up and says, well, I guess they're never going to pay their taxes, so we're going to send them a letter.
Yep.
And at that point, think about the amount of payroll that you've run over 2 to 3 years and how much taxes you should have paid. Not just your taxes. I'm not just talking about the employer side. It's all of the employee side, the withholding that was supposed to be done.
Yep.
All of this.
Yep.
And this is every payroll that gets run. So if you're a bi-monthly payroll and you're running, say, $20,000 in payroll every time you run it.
Yep.
That is a couple of tens of thousands of dollars per month in taxes that you didn't remit. Times 12 is $120,000. Times 2,
Yep.
$240,000 in taxes just in 2 years that didn't ever get paid.
Yep.
And now they're knocking on the door going, we're going to shut you down.
Yep.
We're going to take everything in your bank account.
Oh, and they will too.
And they absolutely will.
They will. Okay, so another topic we can kind of talk about here is fringe benefit opportunities, business smartphones.
Yep.
You can typically purchase a smartphone, provide smartphones and tablets and iPads as a fringe benefit to your employees that work for you. And this benefit can apply to, I don't care if you have a corporation, a partnership, or pretty much any entity structure, right? The business will be allowed to deduct the cost of that. Recipients do not pay taxes on the benefit, okay? And the beautiful thing is the recipients don't even need to keep good records that they're using it for business or personal use. I think that's amazing, actually.
And that's common with most of your fringe benefits. Now, there's rules around how much the value of that can be.
Yes,
right? It
yes.
can't be excessive. Otherwise, it's not a fringe benefit. It's an actual employee benefit that either they need to pay tax on or you do. But yes, there's a myriad of these small little things that you can do with your employees that you can take a write-off for, and it's a benefit for your employees.
Yeah.
And it becomes an attractive HR promo for you.
Yeah.
Right.
Absolutely.
But let's caveat all this. This is only applicable to people that have partnerships, businesses with real employees. It doesn't apply to a solopreneur.
Yeah. Look, guys, we're giving you these little small nuggets per se, right? But realize that you have to be running a legitimate business too, right? Like it's just not getting excessive on here. Rick, I want to ask you an idea. I have an idea for you. How can someone transform their next vacation into business travel?
That's a great question. It's actually one I get a lot from clients is I hear that you can take a vacation and write it off. How do I do it? Well, there's a couple of different ways that you can do it. And it really depends on what type of trip you're taking and how long it is, that type of thing. So how do you do it? First of all, the primary purpose of that vacation has to be for a business.
Has to be,
right? It can't be my Disney vacation and I go see one client.
Yeah.
That doesn't become a business trip.
Nope.
So there's rules around how many days of the trip it is and how many of those have to be business, how many of those to be personal days, what you can write off, how you document it, because again, it's about documentation. But if you are able to qualify it as a business trip, you can write off things like travel, the airplane tickets if you're driving, or if you have to rent a car or something like that. The hotel, some of the hotel can be written off. Some of your actual food costs can be written off. Anything that would be essential for if the entire trip was a business trip, that you would normally take it off. Some of that can actually be done. Now, what do you have to do? One, you have to show that there was a business purpose for it, right? So you go visit a client or a business partner, or maybe you're doing a seminar there, right? And then I think one of the key things right now is cruises, right? I can take a cruise and take some CPE on my cruise and turn it into a business trip, right? And so the value of that cruise then becomes a business deduction. This does not count though if it's not an overnight stay. Right. So it can't be, I'm driving from Houston to Austin and I'm going to spend, just part of my day there, enjoying the sights, and maybe I meet with one person while I'm there. That's not a business trip. And then, it has to you basically have to justify that, would you have done this trip if there wasn't a personal piece to it? Right. So would I still go see this client? Would I still go see this business partner if I wasn't also going to take the vacation? And so that's they call it the for only test. Would I still do this if I'd still need to go see this person? And if that is, then yes, it would. Again, for CPE, do I still, as a CPA, do I have to have CPE? Yes, I do. So would I still go do this trip even if there wasn't a pleasure part of this? Yes, I would.
Yeah. I know myself, many times a year, I would always fly out to Durango, Colorado. Right? So I had clients out in Colorado, had clients in New Mexico, and I would make that drive back and forth. And I'd go fly out there with some business associates, and certainly maybe in the evening time after we met, we'd have honestly 3, 4, 5 meetings a day, Rick, and it was literally at each person's house. It was like bam, bam, bam. And so then you had to travel in between. And we might go out to dinner and eat some wings and have a couple beers later in the afternoon, but I wouldn't have been going out there if we didn't have business. I can assure you that, and, I think was there a time that maybe I got on the slopes and skied a little bit? There was for like half a day. But everything else I did was 100% business related,
right?
And I wouldn't have went out there for half a day of snow skiing. I can tell you that.
No, absolutely.
I wouldn't have incurred that expense for that. It wouldn't have happened. So, the point I'm making, and I think you've made it too, is there clearly has to be a business purpose, right? If there's not a business purpose, it's not going to pass muster with the IRS, right? There's really not much to harp on that. Okay, so I want to do a little bit of Q&A here, okay? If you're okay with this, okay? These are some questions that have come up, And I'm going to throw these questions up there, and you'll throw some questions back at me, and we'll kind of go back and forth, okay? So my accountant told me my meals are not deductible. He said that I can deduct the client's meals only. I have 2 documented business meals a week, during which I do one of the following things. I show homes to clients for their possible purchase. I ask for referrals. Question prospects about what type of home they're looking for. I thought when I paid the tab for the cost of breakfast, lunch, or coffee, which included the client or prospect and me, that I could deduct the full cost, not just the client's or prospect's cost. Am I right?
So you are right. The person that gave you the information is wrong. As long as there's an associated business reason for that meal, whether it's just to sit down to get to know the person, or it's an actual client and you're trying to get information from them, the full cost is deductible. Now, the IRS has rules around how much of that is deductible. It's 50% most of the time, right? So you absolutely, anytime you're dealing with a client, that meal should be entered as a deductible meal. Yep.
Rick, do you want to hit on for a second when the meal would be considered 100% deductible?
So there's a couple of rules around when it's 100%, right? And it's usually around providing employees a meal. And it has to be for their benefit to continue to work, right? So you and I, we often will spring for lunch, right? For our employees. So we'll either take them out or bring them in. Bring in lunch, and it's one, a morale booster, right? But 2, it's to keep them busy, help them to stay efficient with their work, right? So what we want is, you can't just take your employee out just to take your employee out. There has to be, you have to show that you did it to both keep the employee efficient in their work and that it provides some kind of benefit to the business.
Yeah, I agree with that. Like what I always used to advise clients on is if you are potentially still generating income by them working through lunch or something and working, right, which would create a taxability for the IRS, you can take 100% deduction on that.
Correct.
If you're prospecting or something like that, it's typically like you're paying Dutch, it's 50-50.
Right.
Things like that. Rick, you want to ask me a question?
Sure. So, hypothetical, my wife and I own an S corp, and we're doing financial services, our favorite thing.
Okay.
And so we operate it, but we do it out of our house. Okay. And we have a house, we have an office at our house, and it qualifies as our principal office for the business. Okay. Can we rent out that office in the S corp and take a deduction and or show income?
You can, but you shouldn't.
Why not?
The rental's not going to give you any tax benefit. Instead, probably the best thing to do is to have the S corporation just reimburse you as an employee for the cost of using the home office. Okay. You can use that on Form 8829, which shows the home office that you have on there. And it's going to basically have the pro rata expenses to operate that home office, right? So let's just say, hypothetically, 10% of your house is your home office. So 10% of your expenses would be deducted. That might be anything from mortgage interest to property taxes to maintenance that's done. It might even be electricity, water, trash, anything that's associated, right, to keep that up. Well, 1/10 of that won't report on the 8829, but you should basically just use it as an employee reimbursement.
So I would take a cash or a check from the business to reimburse myself monthly, quarterly, or even annually.
Yes.
For that estimated cost of the business piece of my home.
Yep. You and what I like to see is you need to submit a request, and just like it's a difference here. I'm sending a request to have reimbursement to the corporation.
Just like if you were an employee asking your employer for a reimbursement.
You got it.
Out-of-pocket costs.
You got it.
Right.
And getting back to documentation is key. Show an intent and what we're trying to accomplish here. Okay, so I've got a question for you, Rick. Who should own the business car? A corporation or the individual? I operate a business and have numerous clients who operate as single owner S corps. They all want opinions, so it seems, on who should own the business vehicle, the individual or the corporation, and what the ramifications are. I get confused on the best way to handle this. Can you help?
Yeah. So this is a common thing for people that start these businesses. They want to know, if I use my personal vehicle in the business, should I put it in the business? Should I buy a car and put it in the business? What should I do? And the answer is, it depends. It really does, right? What I tell my clients is, if it's a personal vehicle, don't put it in the business, because you're going to use it personally.
Exactly.
And the IRS hates that, right? It could constructively create income to you for using it. If you list it as a business asset and you're personally using it, you will limit the deductions you can take on that vehicle as well, for the same reason, because you only get pro rata how much, and it has to be more than 51% of the use has to be business. So, and it's hard to take depreciation, all the different things on it, right? So my recommendation, if it's a personal vehicle, is just like with the home office, reimburse yourself. Calculate the business use of your vehicle and charge it to the business. Submit a reimbursement form for the mileage or the gas, however you want to do it. But that's what I would do it. Now, if it is an actual company vehicle, absolutely we want that car in the business so that we can take full advantage of the deductions that you can take with that.
And I'll be honest with you, when I give clients advice on this, Rick, I always ask them, do you have another vehicle that you're using for personal? And invariably, if the answer is like, well, no, man, I don't have another vehicle. Like, well, then let's not do that. Let's not put it in the company. Right? Reimburse yourself back out of it. Plus, let's be honest. If you're using this for business and you go acquire business insurance on that vehicle, that's going to cost you more money than it is under your personal policy.
And if you don't I already had this happen with one of my clients. They had a vehicle they were using for business purposes, driving around, got into an accident, but because they didn't have commercial insurance, their current regular insurance did not cover it, because they knew that it was being used for a business vehicle. So it was not being used as a primary personal vehicle. And so they said, you're outside of the scope of our contract. We're not covering it. And so they had to come out of pocket for the funds for that.
Yeah, absolutely. Absolutely. And getting back to that, I mean, you said the IRS doesn't like it when you use your personal vehicle and put it inside the business. They don't. That is another example of commingling assets, commingling personal with business. Separate it. Okay. I want to ask you a question, Rick, another Q&A here.
Okay.
And basically it's on the subject matter of how the IRS disappears tax refunds on unfiled tax returns. So the question is this: I have a client who has not filed their taxes in 10 years, and now their IRS is after his returns. The problem is not that he owes money, but he has overpaid by at least $100,000, and the IRS will not refund his money. Are you aware of any ideas to open up those returns for a refund?
Well, there's the typical, we talked about this earlier, the 3-year limitation, right?
Yes.
So the first thing we always tell people is, if you want to start with those 3 years. The last 3 years we can file. If you're due a refund on any of those, you absolutely can get that money back. There's also, depending on a time frame of when things were filed, statute of limitation is 3 years as well. So if you were 10 years behind and you filed a return before coming to us, and maybe you accidentally paid a bunch of taxes on that return, and we look at it and we're like, you calculated this wrong, we need to amend this return, even though the return was due 10 years ago, the fact that you filed it this last year, the window starts 3 years from when you file that return. So we can amend that return and get money back on that return, even though it should have been due back 10 years ago. So absolutely we can do it that way as well.
Or it's 2 years after they've paid.
Correct.
As well.
Or 2 years after you've paid, right?
Yep.
So if you haven't filed those returns, absolutely we can we can work on that. Now, if this, again, if you're W-2 and it's all just been withholding, unfortunately, you can't go back and get anything beyond the 3 years. So if you're a W-2 person and you were owed money back beyond that 3-year mark, unfortunately, you're kind of SOL. You're not going to get that money.
Yeah. And look, guys, the IRS published some information back in March of 2024. And basically, there were 940,000 taxpayers at that time that had refunds coming to them to the accrued number of $1 billion. Well, guess what? It completely expired. So the IRS gets to keep it.
Yeah.
Okay. So look, I can't emphasize it enough, man. Like, get the right people. So you're not one of those 940,000 and the IRS doesn't get to keep your hard-earned money.
Yeah.
All
right. So if I've got a business, my prior repair told me that if I don't have business income, I don't have to file a tax return, right? And I can't claim a home office deduction if I'm working out of my my home, right? Do I have to file a tax return, and can I get a home office deduction?
Well, so let's talk about that for a second. First of all, I think that's bad advice. Okay. The first thing I would tell you is, yeah, if you operate a business, you have a fiduciary responsibility. You need to file that business return, okay? Even if you're showing a loss, right? So what you have in this business is you generate what they call NOLs, or net operating losses. And those NOLs are going to carry forward. So while today you didn't make any money and you generated a loss, what happens next year? Let's say you had a $10,000 loss in 2024 and you go into 2025 and now you have a $10,000 gain. Well, now you got to pay taxes on the $10,000 gain, Rick. And because you didn't file your taxes in 2024, whereas if you would have filed your taxes, had that NOL, you would have had what they call a suspended loss that would have carried forward for up to 20 years. Then you would have paid zero in taxes for each respective year by making sure you're filed and staying in compliance. So to answer your question, you need to absolutely do that, in my opinion.
So let's look at some other things. We talked about the cars a little bit. What are your options in calculating what the car deduction really ends up being?
The car deduction and using the vehicle?
Using the vehicle. Well,
I think for an S corp, are we talking about a Schedule C, or what are we talking about in this regard?
Let's do both. Let's say I'm a solopreneur. I have maybe an LLC, but I haven't made an S corp election, and I want to maximize my deduction for an auto.
Well, you can look at what your total expenses are that's associated with that depreciation, or you can take mileage. I can tell you that years and years ago, Rick, mileage used to be the way. I still think it still can be today, but the IRS has gotten a lot more stringent. And so if they ever call your return into question, one of the little apps that I like out there, because everybody nowadays has smartphones, right, is that Mile IQ, right? Mm-hmm. And you can click that button and you can click in it and you can put it as a business mile and you can print those reports out. A lot of times also what the IRS will do, because you'll put on there how many miles that you drive that are business related versus personal related. And so what they'll do sometimes is they'll say, we need to see corresponding oil changes from a third party that shows that you've actually put in this amount of time. Have you ever seen that before?
I have. It's like pro-forming financials, right?
Yeah, from a third party that validates that you actually put in, and it's showing on these dates that you've got your oil change or your tires rotated or any maintenance done.
Yeah.
And
the thing is most of these oil change places, that when they do it, it goes to a state record, right? So so the IRS can require that you go out and pull that state record that shows that you did the maintenance, that you did all the things that you were supposed to do.
Yep.
And the thing is, every time you go in, what's the thing they ask you? How many miles are on your car, right?
Yep.
They track that
every time. So I'm not sure that mileage is the best way, because in my experience that if you get called into question, there are so many variables now with the mile IQ and with the mileage that I feel like your documentation has to be very, very good.
It does. My caveat when people ask me this question is always, how long do you plan on owning the vehicle? Because people, and I think that people have gotten away from this. I think the average length of use has increased because of the prices of used vehicles and things like that. And then we had the car shortage for a couple of years. So it wasn't really easy to go out and buy a new vehicle. But it used to be people's turnover rate was less than 3 years.
Yeah.
People would own a vehicle less than 3 years. And I would tell them, if that is the case, if you're not leasing, if you're buying, use mileage.
Well, and I'm glad you mentioned that about the leasing stuff, because I can't tell you, and I know you've seen this too, how many times people come to us and ask us, should I buy or should I lease? And I mean, if you want the greater deduction, most of the time it's the lease. Most of the time, unless you have accelerated depreciation, but at some point you might have some recapture associated with that. So it's a double-edged sword. But I always say that should never be your sole determination.
Right.
Like you just said, how often are you going to go into a new vehicle? Right? Like there's so many different variables that you have to ask. And so I love the terminology that you said earlier, Rick, when you said lazy tax advice.
Yeah.
I feel like if someone can just give you an answer, should you lease or should you buy? That's lazy tax advice for that too.
Yeah, and I can tell you, a number of people come in and told me, yeah, my last CPA told me I should always lease a vehicle. Why?
Yeah.
What did they base that off of? Because if you're someone that is maybe you're strapped on cash flow, putting down that down payment every 2 or 3 years for the new lease, it can be quite unaffordable, right?
Right. And hey, even there's certain vehicles, right, that after a certain amount of time, like I like to say, like those vehicles are money pits. Like you dump so much into the maintenance it's associated, right?
Yep.
I had a BMW years ago, 650i, and I can tell you that I had a really close friend that he would do all the work at a very, very reasonable price, like cheaper than anywhere if I went to the dealership or anything like that. And it was still expensive, Rick.
Yep.
Like it was nonstop. So buying a vehicle like that,
yeah, again, and this goes back to the same discussion with like the IRAs and stuff. It doesn't matter whether you can get the big deduction. It matters on your cash flow. Can you afford to do what you're going to do? If not, you're going to set yourself up for failure.
Yeah. So I want to talk about one other thing real quick, because I know we got to kind of wrap this up.
Sure.
We kind of went a little bit long on this, but it's so great. When we're having these conversations, I just kind of get enthralled in this. So I love it myself. Hurricane Beryl that just hit us, Rick.
Yep.
There's some changes and things that have just happened with the filing requirements. Do you want to maybe hit on some of these little changes on the dates that now have been pushed? I know you and I aren't a big fan of that.
No.
Right?
No.
we like to get things filed on time. And look, guys, just because these dates have now moved, we are by no means advocating that you should move the filing for you. And in fact, just the opposite. We just get it past you and get it done.
Yeah. So, with any federal emergency, which Hurricane Beryl was determined to be a federal emergency, there's usually an extension of the deadlines that are due, right? And so, I think for Harvey, they extended it out to January of that next year. For this current one, Hurricane Beryl, they've now given a new date of February 3rd, 2025. So if you have not currently filed your tax return, and you're on an extension, and if you're a business extension and you're due September 15th, or you're a personal or C Corp and you're due October 15th, you now have both dates now are extended to February 3rd, 2025. Additionally, if you had a payroll run during this period that maybe you got disrupted and weren't able to pay your taxes because you had no electricity, those have all been suspended as well as estimated payments that are coming up, right? So they're giving us some additional time to do those types of things. But like you've said, don't procrastinate. Don't take this as, okay, now I got 3 more months to do all this stuff. Because here's what's going to happen, guys. And this is what happened during Harvey. I remember it well. Everyone that took advantage of this waited to the last minute to get their taxes filed in January, and this year would be February. And now you're a year behind on getting your 2024 stuff done. And not only are you now you're on your an extension, but now you're rushing everything to try and get everything over for your next year's stuff.
Yes.
And you're creating a backlog on yourself and on us.
Well, and that's the tax planning aspect associated with it too, right? Going forward in the projections. Guys, like if you have the means and you have the ability to do it, if you didn't really sustain that, the reason they extended this is because of all the damage. But if you weren't one of those individuals that sustained that damage, don't use it as a crutch. Like just no, just go ahead, get it filed. Let's move on, and let's focus on business. Let's start growing that organization, get things where it needs to be. Let's not worry about shit that will do no benefit for us. I'm sorry to say it in that capacity, but that's the truth.
Well, and on top of that, these extensions of deadlines, they don't change the amounts that you're going to owe or when or the payments are due or anything like that.
No,
you still have to make these payments.
Yeah.
So by you extending yourself out, if you owe right now on a tax return, you're already having late filing penalties for not having paid those amounts yet.
Yep.
And interest is already accruing.
Yep.
If you push it out 3 more months, you just racked up 3 more months of penalties and interest.
Yeah. Agreed. Now, one thing I do want to kind of hit on here, Rick, is if you are one of those individuals that sustained some losses, first and foremost, I'm so sorry. We actually had one of our employees where a massive tree went right directly through their house. So I understand what they're going through.
Yes.
And so you have what they call a casualty loss. Now, there's some rules associated with the casualty loss and the deductibility that's associated. If you sustain some losses, and we would file that on as a casualty loss, but it's only going to be applicable if you are itemizing. So if you're itemizing, what happens is you file it on that casualty loss, and then that will roll back up to your Schedule A as an itemized deduction. Keep all of those deductions, all of those expenses that's associated. I mean, I don't care if it's anything that the insurance company didn't reimburse you for. If you lost power and you had to restock food and everything else because you had to throw all that stuff out, anything that's associated, any damages, any proof of expenses that you incurred that you were not reimbursed for, and you happen to itemize, you need to get that to your preparer. If you're our client, get it to us. Because you might, I'm not saying that it applies until we look at your whole specific situation, but if you happen to itemize and those losses are pretty substantial, there's a good possibility it might benefit you.
Yeah, and I think you said it that aren't reimbursed. So if you had insurance and insurance is covering some of that, that doesn't mean you can't take a deduction.
No double
dipping. Anything that you got repaid for, you don't get to claim as a tax deduction. So if you, unfortunately, like our employee, had a tree go through your house and you suffered, say, $100,000 worth of damage in your house, and the insurance company said, well, you have a deductible you got to meet, and we think your house was only worth this, so we're only going to give you $80,000.
Yep.
You only get to claim the $20,000 difference.
Yeah, absolutely. Yeah, well said. They're not going to allow you to double dip. So we've come to the end, and thank you, everybody. I know it's been a longer podcast than we normally do. So in closing, I just want to reiterate, and maybe you can elaborate on it, the importance of having the right team in place, the right tax advisors, tax compliance, whether it be the preparers, the bookkeepers, the CFO. Can you just elaborate just a little bit? Just what's the importance of having everything kind of in-house?
Yeah.
You can do all that.
So I'll you and I both are in agreement on this. It's about your team.
Yeah.
It's about your team. If you're a business owner, you got to have a team.
You do.
And that team needs to be a strong accountant that can provide you all the things that you need to run your business. And that is, as you said, bookkeeping, doing your taxes, being that CFO. Having it all in one place is going to save you a lot of time and a lot of money.
Yes.
Okay? Because you're not having to go to 2 or 3 different people and go, well, I need my bookkeeper to get the financials done so they can get it over to my tax preparer, who then can get the taxes done so my CFO can look at it and then tell me what I need to do.
Guys, that's so inefficient. Look, you think they're going to communicate? They're not going to communicate. Do we communicate with all of our staff in the back? Absolutely. We're here with them every single day.
Yeah.
So there's going to be less errors and omissions that's associated with that.
Yeah.
More opportunities. And as your organization grows, your team will grow with you.
Yeah.
We have the bill, like I say, our largest client does probably $250 million a year in revenue. I mean, that's pretty substantial. So, and we've been with them for, God, I don't even know how long now, Rick.
At least 10 years.
Yeah, something like that. And so where I'm going with this is you need to have the right team that can grow with you as you go through your different business cycles and as you continue to grow and continue to evolve. Because the last thing you want is to hire somebody that can handle this, and then now you've expanded to this, and now you're, oh shit, like I can't still use them. I got to go find somebody else. And then you're getting reacquainted, reacclimated, and then do you know you have the right people even then? Right? You start this whole process all over. It's almost like dating again, right? It's like you get divorced, right? You went to this next business, like you get divorced, and then you got to start that dating process. Just get married to the right person first. Get married to the right team first that can grow with you. And you will evolve as you see fit. Rick, thanks for your time today.
Yeah, appreciate it.
Hopefully this has been very insightful for all you, even me, right? I learn something every time you and I talk, and I'm sure you feel the same way, right? It kind of reiterates things.
Absolutely.
This is what we're here for, guys. We're here. We want to be your team. If you just want a second set of opinion on something, or hopefully even if you have somebody and you just want to take this information, take it back to your CPA, your preparer, your EA, whoever that person is, your advisory team. Like I said, it warms our heart. We're glad we can provide any information for you. Thanks so much, and have a blessed day.
Absolutely.